There is a massive, institutional time bomb ticking beneath the surface of the United States housing market right now, and the fuse is burning fastest inside the coastal communities of Florida. For years, everyday homeowners believed that as long as property values remained high, their investment was perfectly secure. They assumed that their growing paper equity was a bulletproof shield designed to guarantee their middle-class stability. But in 2026, a terrifying structural trap has opened up between the collapsing insurance market and global banking institutions. We are witnessing the early stages of a quiet mortgage crisis that has absolutely nothing to do with traditional buyer interest. Your family home is no longer operating as a secure store of generational wealth. It has officially converted into a volatile financial liability. And this is where things get ugly. Imagine spending 15 years making your mortgage payments on time, watching your loan balance steadily decrease. You look at the online real estate charts, and the local agents assure you that your home is a gold mine. But on an ordinary Tuesday morning, a certified letter arrives from your global lending institution. The notice demands that you provide proof of active, comprehensive hazard coverage within 30 days or face immediate corporate penalties. This is the cold reality facing over 60% of property owners across the coastal zones of the state. The mainstream real estate networks keep producing segments showcasing wealthy buyers paying cash for luxury oceanfront estates. But on the ground, everyday working families are realizing that their hard-earned home equity is trapped inside a collapsing system. Would you continue to invest your monthly income into a property where the lender can threaten your status due to factors outside your control? Of course, independent individuals who possess complete title to their land without an active bank loan are immune to this immediate notification. Yet, for the traditional suburban baseline that relies on institutional financing, the trap begins with a technical contract violation. Most traditional consumers assume that as long as they send their principal and interest payments on time, the bank cannot touch their home. But inside a standard American mortgage agreement, there is a strict legal requirement that almost nobody reads: the hazard insurance clause. In 2026, as the largest private insurance corporations quietly cancel policies and flee the region, thousands of homeowners experience a coverage lapse. The moment your policy is canceled and your yard sits uncovered, the bank's automated compliance software flags your account. You are instantly placed into a status known as a technical default. The corporate public relations teams distribute notices claiming these severe terms are required to maintain stability across the broader credit markets. But the practical reality is that you are classified as a delinquent borrower simply because corporate underwriters blacklisted your zip code. Do you believe it is fair for a global financial institution to invalidate your contract because the private insurance market dissolved? Naturally, lending organizations must enforce basic security protocols to prevent massive asset devaluations across their loan portfolios. But this rigid institutional retreat is leaving regular working families completely exposed to the next phase of the trap. When independent homeowners discover that the private market has abandoned them, some think they can just ride it out uninsured. They think, I will take the risk myself, protect my own roof, and save thousands of dollars in annual premium fees. But the global banking cartels will never allow a consumer to walk away from their secured collateral. The moment the automated compliance system confirms your coverage has lapsed, the lender initiates force-placed insurance. The bank uses its own corporate partners to purchase an emergency policy and attaches the bill directly to your mortgage payment. These penalty coverages cost up to 4 times more than a standard retail policy, yet they offer zero personal liability protection for your family. The financial advisors on television always market a 30-year mortgage as the ultimate foundation for personal freedom and security. But in an uninsurable market, that contract converts into a legal mechanism that can suffocate your liquid cash flow overnight. What option does a traditional household possess when a banking algorithm has the legal power to add $1,500 to their monthly bills? Granted, elite real estate syndicates with vast cash reserves can self-insure their residential investments without triggering these bank penalties. But for the middle-class family living on a fixed baseline budget, this sudden inflation leads directly to the foreclosure machine. Many struggling property owners believe that if they fall behind due to these forced premiums, they can negotiate a modification plan. They expect to sit down with a local loan officer, explain the corporate insurance crisis, and find an amicable solution. But in 2026, the human element has been completely removed from the debt management system. We are entering a brutal wave of automated foreclosures driven by pure algorithmic processing. When your escrow account drops below the mandatory threshold due to the force-placed insurance bills, the computer triggers the legal process. The mainstream financial reports keep publishing articles stating that national delinquency rates remain within historic margins of safety. But they hide the escalating volume of technical default warnings and accelerated foreclosure filings hitting suburban neighborhoods. Would you continue to deplete your retirement savings to pay a forced corporate penalty, or would you accept the loss and walk away? To be fair, inland agricultural communities located away from the primary storm corridors are maintaining perfectly stable transactional volumes. However, across the high-density coastal sectors, this automated liquidation is creating an opening for a new class of buyers. The moment a traditional family is broken by the system and forced to surrender their equity, a corporate buyer is waiting at the door. It isn't another young local couple looking for an affordable suburban neighborhood to raise their children. It is institutional private equity syndicates and multi-billion-dollar Wall Street landlords armed with massive pools of global cash. Statistics from the housing sector indicate that corporate entities are acquiring these distressed, underinsured properties at an unprecedented rate. They bypassed the traditional retail insurance crisis completely because they possess the scale to self-insure thousands of structures simultaneously. The business publications praise these large-scale acquisitions, claiming they inject vital liquidity and modernization into the local housing market. An economy that liquidates independent homeownership to construct a permanent corporate rental class is destroying the American dream. Will the next generation ever have the luxury of owning land? Or will they exist as permanent renters to a software algorithm? Granted, state development agencies are attempting to expand local subsidy funds to help working-class consumers protect their properties. But the sheer volume of Wall Street capital moving into these crashing zip codes completely overwhelms those modest regulatory boundaries. This systematic extraction of independent wealth is accelerating a historic migration shift across the Southern Territory. A forced relocation of middle-class capital away from the uninsurable zones. Internal demographic data from the Census Bureau is tracking a consistent pattern of long-term residents quietly leaving the state. Families are liquidating what they can, packing up moving vans and shifting toward border states like Georgia, Alabama, and the Carolinas. They aren't leaving because they grew tired of the coast. They are leaving because the carrying cost of property has broken their survival budget. The local politicians love to celebrate the arrival of high-net-worth executives moving to luxury penthouses in downtown Miami. But they remain completely silent about the departure of the essential workforce, the teachers, the mechanics, and the retired seniors. An isolated real estate market that prices out its own productive middle class cannot sustain its long-term asset valuations. Of course, regional demographic rebalancing is a natural corrective mechanism within a hyperinflated territory, and certain domestic sectors continue to show growth. Yet, this steady flight of independent families is leaving a permanent scar on the core fabric of the local community. If you are watching this investigation from a quiet suburb in Texas, California, or the Midwest, do not make the mistake of looking away. This is not a localized Florida story. This is the structural blueprint for an unaffordable America. The identical risk matrices and corporate financial tools are being deployed inside your home states right now. The private insurance syndicates are rewriting the terms of property ownership from coast to coast, turning homes into elite commodities. The government agencies continue to publish optimistic statements, claiming the national financial system remains perfectly resilient. But the data on the ground proves that the core foundation of middle-class wealth is fracturing under the weight of hidden costs. Take a hard look at your own property renewals, escrow balances, and local tax assessments this quarter. Are you starting to notice the early indicators of this economic squeeze appearing inside your own zip code? Share your local numbers and your personal experiences in the comments section below, so we can track how fast this system is expanding across the nation. The United States has historically adjusted to structural shocks, and new legislative boundaries may eventually step in to protect the consumers. But before those macro protections arrive at your front door, independent homeowners must see the reality of the trap clearly. Subscribe to remain informed, protect your wealth, and we will see you in the next report.